Welcome to this video on FX basics. Now in this video we'll be following on from your introduction to financial markets as a whole by focusing our attention more specifically on the Forex market and how professionals trade it. We'll be looking at what Forex is, why we trade it, the different market participants and how they trade it, so that in the next videos we can focus on the 4 pillars of professional FX trading. By the end of this video, you will be in a position to begin learning about how to analyse and trade this market in much more depth. So, without further ado, let's begin with what Forex trading is. The Forex markets, or FX markets as they're commonly called by professionals, is of course where currencies of different nations around the world are traded and exchanged. Now the market itself is the world's largest, and all of the various elements of this equate to around $5 trillion per day in traded volume. This means that it's the least vulnerable to interventions and manipulation by a single entity over a sustained period of time. The spot market, which is what we'll be trading predominantly, is worth about $1.5 trillion per day, which is still bigger than any other related market on its own. Now when trading FX markets, we're literally buying and selling money. A good example is to liken it to the more widely understood stock market, where we buy shares in individual companies and then have a vested interest in the success or failure of that company. With FX, buying a currency is like buying a share in that particular country. The price of the currency is usually a direct reflection of how the market is viewing the current and future health of the nation's economy. So if you buy US dollars, then you're effectively expecting and betting on the future success of the US economy. The goal is when you sell those dollars back to the market, you'll end up with a net profit. Now the currency symbols used in FX consist of 3 letters, and the first 2 letters identify the nation behind the currency, and the last letter identifies the currency itself. For example, in the symbol USD, US stands for United States and D stands for dollar. When buying a physical product such as a share in a company, a commodity like oil, or even a day-to-day item such as a loaf of bread, we exchange money for the item we want. If you're buying money, then it's slightly different because you can't buy a dollar with dollars. So instead, currencies in the FX market are bought and sold in pairs. For example, we have the euro and the US dollar, we have the British pound or the Japanese yen, and so on. So whenever you trade FX, you're buying and selling in currency pairs. Now to help you visualise this more clearly, each pair can be broken down into the product and the price. The product is the currency on the left-hand side of the pair as you look at it, and the price is the currency on the right. For example, if you buy the euro-US dollar pair, you're basically buying euros, the product, and the price displayed for that pair is how much a euro will cost you in US dollars. So if the euro-US dollar pair is trading at 125, that means a single euro will cost you $1.25. Generally, the major currencies have the best trading conditions because there are far more people trading them on a daily basis, which means that buying and selling them is relatively simple and there's always sufficient liquidity. The major currencies are largely considered to be US dollar, euro, Canadian dollar, British pound, Swiss franc, Japanese yen, Australian dollar, and New Zealand dollar. Minor currencies have far fewer people trading them and thus have less liquidity, are harder to trade, and also tend to be more expensive to trade. Minor currencies tend to be from emerging economies, so like Brazil, Russia, Mexico, for example. Now, when trading the FX markets, it's important to understand that the market it's not a physical location. It's not like an exchange, like for example the New York Stock Exchange. FX is in fact known as over-the-counter or interbank market, which basically just means that the entire thing is run electronically within a network of banks continuously over a 24-hour period. What this means essentially is that you do not have to be in any central location to place a trade, which allows us to trade from virtually anywhere in the world. In this interbank market, the most actively traded currency is the US dollar, with the euro second and the Japanese yen third. In fact, the reason why much of your training will revolve around US markets and the US dollar currency is because of just how dominant it is on the global financial scene. Another example illustrating this is how the dollar relates to other currencies in terms of the world's FX reserves. According to the IMF, in 2015, the US dollar comprised around 60% of the global currency reserves around the world. So because almost every other investor, business and even central bank own it, the entire market pays very close attention to the US dollar. But why does everyone consider the US dollar so important? There are a few reasons which we'll look at now. So first of all, the US dollar is the world's largest economy. The US dollar is the reserve currency of the world. The United States has the largest and most liquid markets in the world. The US political system is probably the most stable on the planet. They also have the world's unmatched superpower. And finally, the dollar is the medium for most cross-border transactions. For example, oil. If India wants to buy oil from Saudi Arabia, they can only do so in US dollars. Of course, selling its native currency in the process of buying those dollars. So all of these things combined make the US dollar extremely important and US-related data and indicators vital, no matter what currencies you may be trading at any given time. As you've already learned in our introduction to financial markets, most of the liquidity in all markets comes from speculators trading for a profit. This is especially true in Forex markets, and we account for 90% of all volumes transacted on a daily basis. So despite negative press and media attention attached to speculative market trading, it's actually crucial to the smooth running of the entire system. Another thing you should now be aware of is the existence and interrelation between other financial markets. In the FX market, there are multiple ways to trade currencies, and we're just going to take a little bit more time running through them to really cement your understanding of how interconnected these markets are and the roles that they play. So let's start with the spot market. The spot market is where currencies are traded immediately, on the spot, using the current market price. This is the simplest way to trade FX because there's almost unlimited liquidity, resulting in low trading costs, allowing around-the-clock trading. This all means that almost anyone can participate in trading FX on the spot market rather than it being open only to large banks and hedge funds. This is basically why we focus most of our trading activity around trading the spot markets here. One of the oldest forms of trading is actually the futures market, as we looked at earlier. We looked at futures very closely in the introduction video, and you'll probably remember that a futures contract is an agreement to buy or sell a certain asset at a specific price on a particular date. Currency futures were created on the Chicago Mercantile Exchange in the early 1970s. The benefit of futures contracts is they are standardized and traded through a central exchange, which means that the whole market is very transparent and well regulated. This allows all of the transaction history for every trade to be found easily. Another common currency trading product are something called options, which you've probably at least heard of. If you haven't, then options are financial instruments that give the buyer the right or the option, but no obligation, to buy or sell a certain asset at a specified price and option's expiry date. Currency options are also traded via central exchanges like futures. However, they're not quite as attractive as spot or futures because the market hours are limited and the liquidity is much lower, making it far harder for new traders to operate. The final major FX market is something called ETFs. ETF stands for Exchange Traded Fund and is the newest form of currency trading. Now, the purpose of an ETF is to basically allow you to trade anything but in a more liquid market. So you can have property ETFs, stocks ETFs, and of course currency ETFs. You can even have an ETF that is a combination of different products into one, such as stocks and currencies. The main goal of ETFs is to allow traders to diversify away from being exposed to just one currency or asset. ETF markets are not 24 hours, and the biggest downside is that they're usually subject to extra trading commissions and transaction costs that you don't have with simple spot trading. So now we've got a good basic understanding of what FX trading is and all the different ways that currencies are traded by professionals, we'll now look at the question of why. Why trade Forex instead of stocks? Well, the main reason can all be summed up by looking at how easy and inexpensive it is to become an active FX trader versus something like stocks or even commodities. This makes it particularly attractive to new traders like you that are just starting their FX trading business from scratch. Now let's look at some of these advantages of trading spot FX in more detail. First of all, the commissions are far lower, and because it's not centralised, most of the traditional costs associated with trading, such as clearing fees, exchange fees and government fees, do not even exist for FX traders. In fact, the only fees that are really charged are the brokerage commissions for transacting your trades, and these are usually extremely competitive because there are so many brokers out there. Another advantage is that there are no fixed lot sizes. You remember in the introduction, we learned about how each market has its standard minimum trade size. But with FX, you can virtually set your own trade size to minimise the risk that you're exposed to on each position. This alone is a fantastic benefit for new traders who are just starting their business in the industry. Now, another advantage is the fact there is such high liquidity, which means that a trade can be executed at virtually any time of day with no real issues. This means that as soon as you want to enter a trade or exit one, you can do it with a simple click of the mouse. It also means that no single entity can corner the market and manipulate the price over a sustained period of time, which of course makes it much fairer. So as we've seen, despite the many other markets and products used to trade currencies, the most effective one for the purpose of a speculator, and especially one that is new to the business, is by far and away the spot FX market. Okay, so in the next section, we're going to look at the actual structure of the FX market so that our understanding goes just that little bit deeper and your preparation becomes more expanded. So in the FX market, as we've already talked about, it's decentralized, which means that there is no single price. A whole host of entities such as banks, market makers and currency dealers can provide their own price at any given time. As a trader, you will only ever see a single price on your platform, and that price simply depends on where your broker or clearer is getting their prices from in the first place. This creates an environment that is highly competitive, resulting in the best price every time and razor-sharp differences between the buy price and the sell price, which is more commonly known as the spread. Now, you might be thinking this market is just utter chaos with different prices flying around from one different place to another and different people all day long, and it's going to be very stressful. But that, of course, is not the case. The market is actually structured in a neat and organised way, which means that certain participants get their prices from one source while others use alternative sources, and it all falls nicely into kind of a hierarchy or order. So at the top, we have the major banks such as Goldman Sachs. Below them, we've got the electronic dealing platforms such as Reuters and Bloomberg. And then we have the smaller banks, followed by ECN brokers, market makers and hedge funds. And finally, right at the bottom of the pile is the retail trader. So the banks at the top deal directly with each other. And this is where the absolute best prices are found. They usually deal via electronic trading platforms of Reuters or Bloomberg or others. This dealing between banks is basically what the interbank market is. Now, this works very differently to how most smaller trading firms operate, in that the prices and rates all depend on the creditworthiness of the entity trading the product. This process is very similar to how it works when you ask your bank for a loan. The better your credit score and reputation with them, the better rates and overall deal you'll get. At the next rung of the ladder, we have hedge funds, corporations, market makers, and ECN brokers. Because these entities do not have very close relationships with the large interbank network, they must deal their transactions through commercial banks instead. This means that the rates and prices that they get are slightly more expensive than those traded in the interbank network. At the very bottom of the pile, we have retail traders. Almost every new trader will start at this level unless they have extensive capital or unique relationships within the industry. And this is where the worst prices are found. Having said that, due to the vast amount of competition at this level, prices do tend to be very good, and the trading environment is more than competitive throughout the chain. So now we've looked closely at the structure, and we're starting to build a really clear picture of how the FX markets work, both in relation to all the other markets and of course independently. So what we're going to look at now is the actual participants. Now, as you know, we are classed as speculators, and we play a crucial role in providing the market with liquidity. But there are various other market players that's worth being aware of. All of these people are trading away within the structure of the markets at the different levels that we've just looked at. So let's take a closer look at each one in more detail. Okay, so first we have the huge banks at the top of the tree. Think banks like UBS, Citigroup, Barclays and so on. These banks are basically the FX market. They are the one in the same due to how much they dominate everything. So they're all like equal. Next, we have large commercial companies. Now, companies don't trade the FX market for profit, but instead are simply trying to conduct their business in an efficient manner. So, for example, a large corporation in the UK that needs parts from Australia must exchange its British pounds for Australian dollars in order to make the purchase. These types of transactions are usually big, but not big enough to deal directly with the interbank market, so instead they'll deal with smaller commercial banks. Then we have central banks and governments. These entities are involved in the FX markets for a variety of reasons, and most of it is to conduct routine, day-to-day business such as international trade payments, adjusting their currency reserves, and purchasing foreign investments. Central banks also intervene in the currency markets to actively weaken or strengthen their own currency when they're trying to tackle issues revolving around inflation. There are several ways that they can do this, such as indirectly via adjusting interest rates, or directly by physically buying and selling huge amounts of currency in the actual market. At the most indirect end of the scale, a central bank will very often try and talk the currency down by threatening to do something in such a way that the market pays attention, actually trades in that way, thereby creating a self-fulfilling prophecy, or getting the market to do all of the work for them. Finally, we come back to the speculators that are not conducting any business or trying to do anything of tangible value other than making a profit for themselves. Speculation very often gets a bad name, and the uneducated, it seems as though this activity is like massively destabilising for the financial system, with the prospect of traders losing vast sums of money in a short period of time. Now, the reality, as we've looked at several times during your pre-study learning, is that speculators are actually one of the most important cogs in the giant financial machine, and without them, the liquidity would dry up almost overnight, making it virtually impossible for companies and banks to conduct their day-to-day business at reasonable prices in an efficient manner. To illustrate a highly illiquid market, think of properties. Imagine trying to buy a house and sell it in a matter of minutes. Now imagine trying to buy and sell multiple houses in a matter of minutes over the course of a single day. Just thinking about this seems completely ridiculous and totally unrealistic, because we have grown up understanding that it takes weeks and months to transact a deal on a house. The reason for this is largely due to the extremely low volume of buyers and sellers in the market. Now imagine if there were no speculators in the currency markets and it took months before you could buy your holiday money or buy those parts from abroad that were so crucial to your new product. Imagine if the farmer had to wait weeks and months for a profitable price at which to sell his goods. Their produce would spoil and go to waste, and it would just be chaos. This sounds equally ridiculous because of how used we are to having unlimited liquidity in the commodity and FX markets, and all thanks to speculators. So now we know all about the FX markets and how every type of participant is vital in their own way. How did all of this come about? And most importantly, how do we engage in this market to make a profit in the first place? Well, let's take a look at the history of the FX markets and how you can actually transact your trades in order to become a participant. So, the story of modern day FX begins just after the Second World War. At that time, the global economy was in such a mess that the first world governments, if you like, the major governments, decided they needed to implement a system in order to stabilise everything. This became known as the Bretton Woods system, and this agreement set the exchange rate of all currencies against gold. This had the desired effect for a while, but as the major economies started growing again at various speeds, the rules of the system became obsolete. In 1971, it was completely abolished and replaced by a system where the values of each major currency were set according to pure supply and demand from the market. At this time, the only participants that could trade currencies were the large banks in the interbank market, which effectively made it totally inaccessible to smaller traders and firms. In the 1990s, banks began utilising the new computer and internet technology in order to create their own trading platforms that they could provide their clients with live quotes so they could trade themselves at any time, making the whole process much more efficient. As time went by, this technology was converted into platforms that could be accessed and marketed on a large scale for individual traders, and eventually the entire industry of retail brokers came into existence to service this new and booming demand. This now allowed smaller players to enter the arena and compete with the banks, but most importantly inject crucial extra liquidity into the markets. These smaller brokers are what we use to get our business going and trade through until we have enough capital to move up the chain. However, not all of these brokers are created equally, and when selecting which one to begin trading through, it's important to know the differences. There are generally two specific types of broker: a market maker and an ECN. Now, ECN stands for Electronic Communications Network, and this works very cleverly by automatically matching every buyer in the network with every seller. These can be anyone from banks to individual traders, and the volumes of orders are aggregated and assigned in milliseconds. ECN brokers make their money by matching buyers with sellers quickly at the best possible price, and for this, they take a very small commission. These are generally considered to be more transparent because they just simply match orders. On the other hand, there are market makers. Now, these brokers literally create their own market for you to trade in. The advantage of doing this is they can take larger contracts and cut them down into smaller pieces that smaller traders can buy and sell. The downside is that you're never really trading the true market, and the costs are generally much higher because of the greater degree of involvement that those brokers have. Now, as traders, we usually prefer to trade through an ECN because the pricing and execution is considered much more transparent. However, our main goal is to execute trades in a timely and cost-effective manner in an environment that is stable and secure. So selecting a broker based on these criteria is most important, whatever that is.